Hey everybody, I'm attorney Jason McGrath with the law firm of McGrath and Spielberger. We're going to talk today about loss mitigation and loan modification, deeds in lieu of foreclosure, that kind of thing, for folks who have distressed mortgages and perhaps are facing foreclosure. If you're trying to deal with a loan servicer, they're probably going to ask you for your financials. And there are several reasons for that, really. And one of those is because they actually want to evaluate if you have a hardship or not and what your financial circumstances are. Of course, they also want to sneak peek into your financials in case they sue you later. But sometimes that's just a risk that you maybe have to run depending on your circumstance. So one thing they're going to look at with regard to your financials is your monthly gross income versus your total monthly expenses. Another thing they're going to look at is your monthly gross income versus your monthly housing cost. Those two ratios are really important and almost by themselves can determine whether you're going to be offered any type of relief or not. So let's talk about those briefly. First of all, the monthly gross income versus your total monthly expenses. So if you make $5,000 a month, and again, this is gross, and your total monthly expenses, what you need to pay to live by, and also including obligations you've got to pay, other loans, that kind of thing. If your gross monthly income and your total monthly expenses are about even, you're probably in pretty good shape, on that factor at least, to try and get a loan modification. What they don't want to see is where your income is significantly higher than your expenses, because then they think you can pay your loan and you don't need help. They also don't want to see it where your monthly gross income is significantly lower than what your expenses are, if you're pretty negative every month, because then they think to themselves, well, even if we help this person and actually give them a little bit of relief, they're so far underwater every month that they're just going to default again on their loan, assuming that you're in default or delinquent. So basically, if you're $1,000 negative every month, they're probably not going to give you a loan modification. Now, if you're looking for a deed in lieu of foreclosure, they might look at you if you're $1,000 negative per month and say, oh, well, this person really can't afford to pay this loan, and they really can't afford to really pay us anything to make this deal happen. Maybe we'll just take the property from them in exchange for letting them walk away and not pay anything on the loan. But that's one ratio that's important to know about. The other one is the gross monthly income versus the monthly housing cost. And so monthly housing cost basically is the principal and the interest on the loan, as well as the property taxes, the property insurance, and also any HOA type fees. So they'll take those and look at them. So for example, if you're, again, making $5,000 a month and your monthly housing cost, they also call this debt to income ratio, unfortunately, because there's a whole different meaning of debt to income ratio. So I just use the term monthly housing cost. But if you're basically having to pay $3,000 a month toward your mortgage, your interest, your taxes, your insurance, and maybe your HOA, and you only make $5,000 a month, that's not a good ratio. That's 60% of your income going toward your housing costs without anything else. That's not a good ratio. They're probably not going to offer you any type of relief in the way of a loan modification because you're simply paying too much, and their conclusion is going to be, you just need to get out of this property somehow and out of this loan. It just doesn't work for you. Now, on the other hand, if you are making $5,000 a month and you only pay $1,000 for your monthly housing costs, 20%, they're going to pretty much say, well, your monthly housing cost is reasonable. You maybe have other expenses that are too much, but if you're paying only $1,000 of your $5,000 income each month towards your monthly housing costs, that's reasonable, and we're not going to be able to give you a modification that lowers that payment, and so you might be out of luck there. Now again, this is all sort of general commentary, but it's based on years of experience in dealing with a lot of these types of cases. But again, every case is different, every client is different, every loan servicer is different, so you never know. But those are some general guidelines and two really important factors to be aware of. One of the problems we see is that sometimes clients come to us, or really potential clients come to us, and they've already submitted information to a loan servicer, including their financials, without really understanding how it worked and without fully considering everything, and they maybe have gotten rejected because of that, and partly because they didn't understand these ratios and how the bank looks at them, or the loan servicer looks at them. So please keep those items in mind, and if you need help in this kind of law or business law, estate planning, and a few other types of things, go ahead and maybe give us a shout or an email, check our website out, and maybe we can help you. Thanks. Bye.